the Big Beautiful Bill Act and what everybody needs to know in terms of the tax ramifications that this bill has brought. So before we get into the meat of the presentation, I want to introduce um, both my counterparts with me. I've got Evan Radin, as well as Amanda Poliska, who's going to give us some great information today on taxes and the markets. So we're going to cover a lot today. But I'm really, really excited to have both of them on. Of course, they're both CFPs. Evan joins us via way of New York City. And Amanda, you're out there in Cleveland, Ohio. Is that not the case?
Yeah, west side of Cleveland there.
Okay, cool. So we've got all the areas covered. I'm here in DC. So let's get into the agenda. So today we're going to be talking about the tax implications for these new um, rules and laws that got set into place. We're going to talk about the impact on your retirement planning, the healthcare and long-term care provisions that got adjusted, as well as estate planning considerations from these new tax laws. We'll talk about business owner impacts, but we'll keep that fairly short since we're dealing with our federal audience. We'll look at the impacts to not only the stock market, the economy, and the bond market, and then we'll open it up to a live Q&A so that you guys can give us all your great questions, and we'll pretty much make sure that we stay on to the end to answer all of those. So let's get into this bill. What does this bill exactly mean, Evan? What are we talking about with this bill so far?
Yep. So the biggest line item, but also the biggest impact was the current tax brackets are now extended permanently, quote, permanently. Whereas without this bill passing, come 2026, we would have gone back to the pre-Tax Cuts and Jobs Act brackets, which are not as favorable as the current brackets. So if we look at the 2025 brackets and we look at the joint taxable income for someone between 100 and 200,000, the tax rate there is 22%, and then the next 200,000 at 24%. So an effective tax rate from 100,000 to 400,000 for married filing jointly is about 23%. Versus if we go back to the pre-Tax Cuts and Jobs Act brackets, the 100,000 from 100,000 to 200,000 is already at 25%. The next 100,000 is at 28%, and 120,000 of that would have been taxed at 33%. So pretty stark difference of going from 23 effective tax rate to 25, 28, 33. So this is the biggest item that happened in this bill is going forward, we are keeping the 2025 brackets permanently. The reason that I use the air quotes is if we go back in history and we look at the historical tax brackets, we were just saying the pre-Tax Cuts and Jobs Act brackets weren't great, but if you go even before then, the tax brackets were even higher. So at some point, we can all agree that with the current deficit and that the deficit that this bill is projected to add, tax rates are going to need to go up at some point. It's just a matter of how much and when. So the impact for our clients is, I was just having a meeting with a client this morning who said it's not as much of a priority to get the Roth conversions because we're seeing these brackets extended. That's true. There's not as much urgency this year, but if we're looking long term, it's really important to get those Roth conversions done sooner than later and efficiently as always to make sure that we're paying the favorable tax brackets today before they change in the future.
Right. And I just drew a line on this so that we could kind of understand the average tax rate that we've seen for, 100,000 individual and $200,000 joint. And by the way, this is indexed for inflation. That average is somewhere around 26% in marginal tax rate. again, we're at 22 and we've been under 22 since 2018. That's where we're talking about. These are some of the lowest tax levels. Like we saw a little blip here, but that's essentially nothing, right? And now we've been in that lower tax rate for a while. So I agree with you, Evan. So let's talk a little bit about the implications of all these individual kind of adjustments in the tax code. Amanda, what do you got for us there?
Yeah, in addition to, like Evan mentioned, the tax rates, we also have deductions as well that either stayed the same or changed. So we'll start off with the state and local tax, or what's commonly known as the SALT deduction. That has increased. Previous to the Tax Cuts and Jobs Act, there was no limit on the amount that could be deducted previously. But with the passing of that bill, it imposed the cap of $10,000 throughout the year of 2025 there. The deduction now jumps to a cap of $40,000 for households earning under $500,000. And these figures receive an annual increase of 1% per year through 2029, but then revert back to that $10,000 limit in 2030 there. But for any households earning over that $500,000 throughout those years, they remain at that max of $10,000 limit. Two new deductions have also been introduced that are set to sunset in 2028. One we have is the auto loan interest deduction, and taxpayers can deduct up to $10,000 per year in interest paid for any new US assembled vehicle purchases between 2025 and 2028. And you do not have to itemize to receive this, but income phase outs do apply at $150,000 single or $300,000 married, filing joint. And for those who make tips and overtime, the same phase out amounts will also apply, but filers can deduct 25,000 in tips for, and overtime can deduct 12,500 if filing single, or if you file married filing jointly there, 25,000.
Got it.
Yeah. And for those who also have qualifying children, the amount has increased an extra $200 to $2,200 per child. And also the refundable portion staying the same at $1,700, but now both are adjusted for inflation annually. Something to note as well, the phase out thresholds actually remain the same though. So 200,000 if you're single and 400,000 married filing joint there. Also, the miscellaneous deductions that were suspended under the Tax Cuts and Job Act are also permanently suspended now, such as advisory fees, tax prep fees, and unreimbursed employee expenses there.
Got it. Thank you, Amanda. What else do we got in Social Security?
Yeah, Social Security. There's a new deduction. It's actually called the Special Enhanced Senior Deduction that makes benefits effectively tax-free up to 88% of recipients. Now, this deduction is $6,000 per individual age 65 or older. And this is on top of your standard deduction, as well as that age-related boost you get at 65 as well. Now, with this deduction, there are phase outs starting at 75,000 single and 150,000 married filing joints, where that $6,000 deduction is reduced by 6 cents for every dollar over those figures, with a full reduction of that deduction being at 175 as a single filer or 250,000 as a married filing joint. But on our next,
Okay.
yeah. On our next slide here, for many of our clients, we took a look at this and thought, how this would impact those that we recommend Roth conversions for. So as an example on how the deduction could be impacted, we have this scenario, we have a couple married filing jointly, both spouses aged, over 65 to get that full $6,000 per spouse deduction benefit, but with their modified adjusted gross income being at that 210,000, which is just below that first tier of Part B premium at 212,000. Now, with that threshold, 210,000 is 60,000 over that 150, and with 6 cents being deducted for every dollar over that 150, we're left with $3,600 in reduction per spouse, or $2,400 remaining for a total deduction of $4,800 versus the $12,000 that's in this bill here.
Right. Evan, what's your take on this?
Yeah, I mean, when we first saw this playing out, we saw, oh wow, Social Security might be tax free. That might be an even bigger window to do Roth conversions. But then when we saw it actually play out, if you are already receiving Social Security, you're not going to see any changes on your tax return income wise from Social Security. But what you will see going forward is this extra deduction. So I just wanted to clarify that because I think that was a little confusing when it first came out, that it's effectively tax free because of this extra deduction that you get. But going forward, how does this impact our clients? I think it's really going to be a case-to-case basis where sometimes getting that extra deduction might make more sense than doing more conversion. And sometimes doing a bigger conversion to lower the impact of RMDs down the road might be more important than this reduction. So it's really case-to-case basis going forward.
Yeah, if you're already in phase out phase, like you're already in that phase out, I guess we could go back to this as a married filing jointly, and you're almost already in that phase out, then it probably, you're not going to get much of that deduction anyway if you're at the top range of this. And therefore, you probably wouldn't pass on doing a Roth conversion
Right.
because like you're losing a part of this, $6,000 deduction or $12,000 for married. So it's really not as I guess it's not as good as what it looks like on the surface. And it sunsets after 2028. So that's another one. But tell us, Amanda, what else do we have in this bill?
Yeah, so on retirement planning, not too much has changed as you see on the screen here. From a required minimum distribution standpoint, everything still aligns with that Secure 2.0 legislation. So if you're born between 1951 and 1959, your RMD age remains 73. And if you're born 1960 or later, the RMD age still remains that 75 there. Contribution limits are also unchanged, with the 2025 limits for a 401k being that 23,500. And if you're age 50 or over, that $7,500 catch up, and an IRA $7,000 limit with that $1,000 catch up. The only difference here is a new catch up rule that's in effect for tax year 2026. If you are 50 or over and plan on making a catch up contribution to your employer plan, and your income is over $145,000, those funds must be directed to a Roth account if your plan allows. Now, you're still able to make that catch-up contribution, but it won't be deductible, right off the bat. But it will remain growing tax-free as well as when you take it out tax-free as well. But that rule also just applies to employer plans, not IRAs. And conversion rules also remain unchanged. We can still convert those traditional IRAs as well as those traditional 401ks to Roth, and those backdoor Roth IRAs remain available as well. No income limits on conversions there. Yeah,
What
and when
do
it
we have on the health stuff? I'm curious about this one.
Yeah. So when it comes to healthcare, the Medicare provisions, mainly stay the same. There's no changes to the benefits or really the IRMA brackets, and they continue to change with inflation. Really, the big changes is with Medicaid. A new work requirement will be rolled out nationwide for non-disabled adults ages 19 to 64 who don't have children to be eligible for this assistance. Those individuals will be required to work at least 80 hours per month, so essentially part-time there. Also, federal funding for Medicaid will be reduced for the states. So this may create, funding gaps that states will have to address, through their own spending. Think taxes, think cuts to other programs, or just reducing Medicaid coverage and benefits themselves. So given that, costs of long-term care and out-of-pocket costs to individuals is anticipated to raise across many states due to that. But again, also no new deductions or credits when it comes to healthcare expenses here. The medical expense deduction remains the same for any itemized deduction at the difference above that 7.5% AGI, adjusted gross income. And, no new deductions when it comes to long-term care or that family caregiving deduction there.
Awesome. Great information, Amanda. That was a lot to digest. I would like to hear what the changes are in the estate planning side of that. Evan, you got that for us?
Yep. So similar with the tax story, the estate side of it's similar, where we're not shocked by this being implemented in this bill, but it is a pretty stark difference. So we were supposed to see the estate tax exemption go from approaching 14 million back to the Pre-Tax Cuts and Jobs Act, adjusted for inflation, so closer to 7 million per individual of estate tax exemption. So that was going to be 14 million for a married couple, and now going forward, it's 30 million per couple. And what that means is a couple can pass down 30 million to the next generation, avoiding the estate tax. So that is definitely a benefit for those wealthier individuals that you can pass down to the next generation without any estate tax. And if we look at some of the, sorry,
Yeah, one thing I noticed, it's permanent.
and it's
But
permanent.
Social Security drops off. Just the $6,000 or $12,000 deduction drops off at 2028. So it's a very interesting bill. But okay, keep going, Evan.
Another thing that remained unchanged was the annual gift exclusion that is remaining at 19,000 per recipient. And a common misconception with the annual gift exclusion is you can only gift someone 19,000 per year. That is not the case. It just means that anything above that number, you need to report to the IRS. And that goes to that exemption amount that we were talking about in the last slide. So for a lot of people, you can keep on giving and not worrying about estate tax or gifting tax. You just need to report it, anything above that 19,000 number. And that's per individual. So you can give 19,000 to each of your grandkids and not worry about reporting anything to the IRS. If you gift each child or each grandchild 20,000, you just need to report. And then no new limitations on the direct gifts or 529 contributions. No changes to the inherited or beneficiary IRAs. Still the 10-year withdrawal rule. Friendly reminder, this was from the Secure 2.0, not from this bill. Friendly reminder that we do need to start taking RMDs out of these accounts if the person who you inherited the IRA from was taking those RMDs. It was not the case these past couple of years. They were going back and forth about it. And now in 2025, they were very clear about this new rule. So just make sure that you're taking those RMDs out if you need to. And then no changes on the state level tax wise. But keep in mind that some states do have their own different rules for the estate tax exemption. So if you're in a state that's got a lower exemption, there might still be some planning to be done on the estate planning side of things.
Got it.
Another estate planning tool that did not get changed was the step up in basis. And what that means is the step up in basis is, let's say someone had a non-retirement taxable investment account or had a home and paid $200,000 for it, either $200,000 purchase price for the home or invested a total themselves $200,000 into the stock portfolio, and that grew to $500,000 over time. If they were to sell it before they passed away, they would be responsible for $300,000 of gains and need to pay tax on it. which is a pretty big tax bill. What the step up in basis means is if someone inherits that home or inherits that non-retirement account, they get a step up in basis. So if they were to sell it the day after the person passed away that they inherited from, that 300,000 of gain is non-existent because they stepped up to that 500,000 number, which is a very, very good tool that did not get changed.
Awesome. Well, this is obviously settles a lot of the bill. I'm going to talk a little bit about the business side of it. I know our audience really doesn't focus too much on the business owner impact, but I'll just at least mention that there's an expanded bonus depreciation, 100% bonus depreciation extended through 2030, where businesses can fully deduct property that's eligible in the year that they place it into service, which means they don't have to take depreciation over many years. They can actually deduct that all in that 1 year. That includes those vehicles that a lot of business owners took advantage of after that in 2020. But that's within luxury cap limits, as well as computers, machinery, equipment, things like that. It also preserves the pass-through deduction, which is 20% QBI, qualified business income. This is a deduction that just business owners get, and it's now permanent. It's available to sole proprietors, LLCs, S corps, but there aren't income limits. We don't have those income limits on the screen, but as soon as you hit those income thresholds, that 20% deduction phases out and is gone. Okay, so those are the changes to the business side of it. Tell us a little bit about the student loan side of this, Amanda.
Yeah, so there definitely has been some changes made when it comes to education loans that are procured, through the government there. But currently, those who currently use income-driven payment plans, the most common being, the Save on Valuable Education or SAVE, or the Pay as you earn plan pay, those will be eliminated as of July of 2026 here and really replaced with only two options. One option is going to be the standard repayment model. That's, essentially just a fixed loan interest, spanning over 10 to 25 years and really meant to pay that full cost of that loan taken. And the new repayment assistance plan, or RAP as they call it, that is similar to the current income driven plans, but the payments are going to be based on gross income versus discretionary income. And the forgiveness is now a longer timeline of 30 years here. Also, that got rolled out is new lifetime caps on federal student loan borrowing that will be implemented, limiting the total amount that a student or a parent can borrow over their lifetime through these programs. Now, one of the main changes being on those loans, which historically never had really any official caps and often used to cover that full cost of tuition. So those being the parent and grad plus loans, and those being capped now for parents at 65,000 and the grad plus being eliminated altogether. So ultimately, this will cause a shift for families to, increase savings to plans like 529 plans, rely more on scholarship or school-based aid, or seek other resources, like private loans, higher interest rates, fewer borrower protections, and usually require more credit worthiness checks there.
Got it.
And also, consumers and businesses will now see fewer tax, incentives for going green, with the tax credits you see in the chart either being repealed or eliminated. The bill also increases availability of federal leases for oil, gas, and coal by really disconnecting them from the renewable energy leasing requirements established in 2022 with the Inflation Reduction Act. So it lowers coal royalty rates by 5.5% through 2034, also removes the federal tax on methane emissions with the hopes of boosting traditional energy production and reducing regulatory costs there. But other tax credits related to battery storage, hydro, geothermal, nuclear energy, and clean fuel still remain in place there.
Wonderful. All right. So what we want to transition to is the impact that this all potentially has on the markets. Now, it's not just the markets, right? We want to, we've covered a lot, so we're going to keep this part short. But Evan, why don't we talk a little bit about what this kind of means for the stock market?
Yeah, and I was alluding to this before, and this isn't really stock market related, but economy related. The bill is projected to add between 3 and 4.5 trillion to the national debt over the next 10 years. And the biggest factor of that is the extension of these more favorable tax brackets. And if we see what some of these factors that were implemented to try to lower the deficit was the Medicaid cuts and the change to the student loan payments, you can see are not as big as a factor as the extension of the favorable brackets. So I mentioned this before, at some point, we're going to have to see the tax rates go up. It's just a matter of when and how much.
Yeah. And how does that impact the different areas potentially in the market, you think, Evan?
And then more immediate impacts. The clean energy stocks definitely took a hit with those reductions in their credits and the incentives. And then some sectors that we already saw have a benefit, but might continue to have a short-term benefit, are the defense sector, traditional energy because of the weakening competition from the green energy, oil. These are different sectors that in the short term could do well. But on our side, we're not going to make any dramatic decisions on this in our portfolio because we think that those are already priced in for the most part.
Wonderful. And what I'll say to this is, look, lots of our clients rely on guidance on the market for us, but at the end of the day, it's very difficult to project what in the short term is going to happen. Currently, we have tariffs that are still in play, right? I don't think that's gone away. I think the market has potentially neglected the fact that this isn't done yet, and that the tariffs are still a situation that may likely pull the economy down, but we don't know yet. And we're seeing some of that volatility re-enter the market here in July. We would be very, well, not surprised at all to see volatility remain through the rest of the summer up until October. I think we would be also expecting to see some sort of pullback between now and then. That's a short-term perspective in terms of the tariff impacts. Now, from there, what do we expect medium to long term? Well, when a bill such as the big beautiful bill is passed, that essentially is a spending bill, this typically is going to add to the circulation of money in the system. And what you're seeing on this screen is the history of the money supply and its expansion since 1960. You're able to see when we started to decouple from that gold standard and really get aggressive with the amount of US dollars in circulation over the 2000 era, especially post Great Recession right here, asset prices boomed, real estate boomed, stocks boomed, commodities such as gold, even cryptocurrency boom. And then we saw that lift off after COVID. We saw a short-term pullback when inflation was super high back in 2022. But guess what? We're back to doing what we've been doing, which is printing dollars. So when someone asks us, hey, what do we think the market's going to do over the longer term? Let's call it the next 3 to 5 years. I think the bet that we would have is that this money finds its way into assets. You see higher prices for homes, you see higher prices for stocks, you see higher prices for gold and potentially other assets as well. So this is our longer term view, is that this adds to the pricing of those assets. Now, if a recession were to formulate because of some, unbalance in the economy, we think that will come likely from what they call a black swan event that will rapidly reduce the pricing of assets, but that dip will be fairly quickly bought up. And by quickly, I mean 1 to 2 years. We can't assess the damage of a black swan event in generalities, but we do think over time pricing of assets will increase because of this bill. And that's where we want the majority of our clients to be on, if at all possible. Now, we understand some of our clients are in their retirement distribution years, are more conservative in nature as federal employees, but we do think the assets are going to increase. Now, in terms of the impacts that we have to bonds, right? Bonds are in a weird place right now because we have structural imbalances in terms of the economy where, number one, inflation expectations could rise, right? As investors anticipate higher inflation, it could cause demands for yields in bonds to go up to offset the impact of inflation on bond purchasing power, okay? Two, we see policy uncertainty, right, which generates greater volatility in bond prices. We also have seen the credit rating of the US bond market be impacted by its irresponsible spending, right? And now we're sort of adding to that with this bill. Additionally, decline in foreign demand, right? The weaker US dollar, which we've seen the biggest movement to the downside in the US dollar in many, many, many years, right? This puts also downward pressure on yields and on potentially treasury bonds because there's just less demand for them. And there's going to be a bigger supply of treasuries coming into the market to afford all of the bill's expenses that was just passed, which we'll show you here in a second. Again, we mentioned the US dollar trends, but we also think that this is an opportunity for international investing. We've tweaked and rejiggered our portfolio to now have a higher amount of international exposure because of this. And we've already added in 20% of our equities right now are international. That's the largest holding that we've had in international over the last 10 years. It's not even remotely close. We've actually we're almost all US based up until this year or second half of last year. So we've got this weird dynamic at play where we know that the Federal Reserve likely next move is to cut interest rates. We know that there's pressure from the current administration to do that. We also know that the Federal Reserve Chairman Jerome Powell is going to have his term end in May of next year and likely will be replaced with a dovish chairman, which wants to lower interest rates. The secretary, Scott Bessent, has alluded to they want lower interest rates. So we see this as a potential, but we have to keep in mind that even if the Federal Reserve lowers interest rates, that more so impacts the short-term borrowing between banks. It impacts shorter term securities such as money market, bank savings, shorter term treasury bills. but what it doesn't impact is longer term interest-based investments, such as longer term treasuries, corporate bonds, and so on so forth. It also doesn't impact so much mortgage rates. Mortgage rates really are a longer term debt instrument, right? And so if the supply of treasuries come into the market, that will likely have a counterbalance to what the Federal Reserve is doing. It's something that we have to watch closely, right? That deficit in spending that means that treasuries have to issue more bonds to fund the government's operations. That's where the government gets the money from. They issue bonds, which we and other international countries are their debt holders, and they get money for their spending. And we, as debt holders, as well as foreign entities, might just require a higher interest rate on those bonds, which means that those longer term treasury yields stay inflated. And that could create downward pressure on bond prices because, as we know, interest rates are inverse in relationship to bond prices. So what does that mean? Does that mean, oh gosh, I've got to exit out of bonds? It doesn't necessarily mean that. What it means is we got to be very choosy with the bonds that we choose, which we do. We utilize managers to do that, such as PIMCO, a big a bond manager. So that's one way. We don't want to necessarily hold the index like the aggregate bond index necessarily in our portfolios because that's longer dated in maturity. The duration of the aggregate bond index is about 8 or 9 years. We want to be shorter term in interest rates because we do believe that the longer side of the curve, longer term dated bonds may have a little bit of a difficulty as interest rates on that longer term stuff may stay elevated, and that may put a lid on those bond appreciation from those bonds from appreciating. So it's like a Jekyll and Hyde type situation here, right? You've got the Fed wanting to reduce rates, or Fed potentially going to reduce rates, but then you've got the supply of bonds of treasuries going in that may counterbalance that, especially at the longer dated end of the curve. So we're going to watch this very closely. We still believe that bonds provide a strong cushion to your stock portfolio. We're not necessarily recommending that clients bail out of these bonds, but we do believe that the normal scenario when the Fed cuts rates, which means that bond prices usually take off there, that will likely be held in check with the bill. But again, gotta watch it. It's going to be something that we're really interested to see how these yields hold up for the bond side of things.